What's been remarkable to me is how well properties have performed because we haven't seen overbuilding.
Welcome, everyone, to The Landscape. This is George Smith Partners FinFacts podcast. We're really glad to have two very special guests today joining Mr. David Pascale and I here. So just a reminder, if you want to sign up for FinFacts, go to gspartners.com, and that's our weekly newsletter where Mr. Pascale here writes a little bit on economics and interest rates. It's very interesting, and I highly recommend it.
And it's free.
Free.
There you go.
And as usual, we're very excited to have some very special guests. So, David, why don't you introduce who these folks are, and they can give a little bit of background on that.
Well, first of all, we're really pleased to have Tim Sloan, the ex-CEO of Wells Fargo, and we have Michael Llodra of GSP, and he'll talk about some of the things he's working on here.
So, Mike, why don't you go first? Mike's on our team here. We're really glad to have him. He's been with us just a couple of months, but Mike, why don't you tell our listeners what you're up to here at AXCS Capital / George Smith Partners?
Sure. Thanks, Evan. And great to see you again, Tim and Dave. It's a pleasure to be on the podcast. So I recently joined AXCS Capital to really spearhead the investment management part of our business to complement a longstanding focus on the advisory side for middle market real estate sponsors. So really excited to join. I think it's a great time in the market. And I would actually like to just immediately segue to Tim with that and thinking about the opportunity set in commercial real estate, Tim, and your role as a leader at Fortress. This is obviously an interesting cycle, and I'm wondering if you had any thoughts about how this cycle might differ from some of the other ones that you've led teams and organizations through.
Wait. Before we let Tim answer that really good question, Tim, what are you doing over there at Fortress? And I know that's a relatively new step for you on your illustrious career path.
Sure. So I've been at Fortress now for about 4.5 years, and my title is vice chairman. And I have an interesting role here. I sit on our investment committee, so all of the loans or investments that we make for all of our funds goes through an investment committee, and we have to have unanimity to move forward on whatever we do. And then I spend about half my time in the commercial real estate debt business, so that area of Fortress reports up through me, and then also spend a fair amount of my time in and around financial services. We recently made a 24.9% investment in a community bank headquartered in Texas, First Foundation, and then just get involved in helping the firm raise money, help manage the firm. So it's a great place to be. I've known the Fortress principals for decades, and we're really excited to be on the platform.
What's top of mind in terms of how this cycle might be different, Tim, from some of the other cycles that you've led teams and institutions?
Yeah, no, Michael, it's a really good question. Given that I'm 64 years old and have been in banking for over 3 decades, I've been through a number of cycles. I think the important point is they're all different. I always get frustrated when folks try to describe how they're all the same. I think that what's clear here in this cycle, from my perspective, is that it's primarily driven by rates. Now, set office aside for a minute, and I realize saying set office aside for a minute is a big but for all the other product types, the primary driver is that we went through a period where rates were very low, so equity valuations, capital structures were built upon low rates, and now that's changed. So values are down, the cost of capital is up, and that's creating a fair amount of stress and strain. When you look at the underlying performance, right, across almost all product types in almost all markets, there's always some exceptions. And again, this is setting office aside. what's been remarkable to me is how well properties have performed because we haven't seen overbuilding, which we've seen in prior cycles. Again, some markets there is a little bit of overbuilding, but generally not. That's one. And two, we're not in the midst of an economic calamity like, for example, we saw at the GFC. So I would
Mhm.
say office is a separate topic, but everything else driven by rates.
Interesting. And obviously rates have been in the forefront of the news recently. I don't know if you guys caught any of Powell's remarks today at the Economic Club of Washington, but more of the same, what he obviously said last week, wasn't going to say anything new.
No.
So, yeah, Mike, you look like you want to ask a follow-up question there. You're posing for it.
And it was on rates, yes. So rather than speculate where long rates end up, Tim, you obviously just put an economic investment into a bank where the traditional business model is to lend long, borrow short, et cetera. We're in a strange environment with the yield curve being what it is, and I'm just curious what you think the catalysts are for that to uninvert or normalize or whatever the right word is to get us back to more traditional rate conditions.
Right.
Yeah,
Yield curve steepening, will it occur?
oh, it'll absolutely occur, right? I mean, anytime we've been through a period where the yield curve have been inverted or has been flat, it feels like it's never going to end, and it always does. It's going to end for different reasons. I think this cycle, the front end of the yield curve is going to decline as opposed to the back end significantly increasing. And
Mhm.
we saw the inflation, the CPI print last week. It's not the only time that inflation or the CPI read has been reduced from prior months or prior quarters. But I think it's going to be a combination of inflation coming down and economic activity slowing. And we're clearly seeing economic activity, particularly in middle and lower income Americans, begin to decline a bit. Doesn't mean we're going into a recession, but I think that those two drivers will force the Fed, and it's
Mhm.
hard for them right now because the political overlay and
Right.
but the fact of the matter is they're going to begin to reduce the front end of the yield curve. I don't think that they'll go back to the 25 basis points or 50 basis points or even 100, but I could certainly see, in a couple of years, it being back to, instead of being 5.25, being down to 2.25. I think that's possible.
And it's interesting, they talk about the R-star rate, the neutral rate, and how estimates range from about 2.5 to maybe even 3.25. So you think we're getting back down to that Goldilocks rate, or that's what we're trying to get to?
Yeah, I think absent an economic calamity or some geopolitical
Right.
impact like COVID or some war or something like that, I think it's reasonable to assume that we'll slowly but surely kind of meander back to those rates.
Mm-hmm. Let me ask a question. We recently had the living will stress test for the big four, too big to fail banks. And they're talking about easing some of those regulations. Basel III reckoning is coming up. What do they call it? The true up end game. The Basel III end game is coming up. The mid-level banks of $100 billion or more in assets just had their tests. What do you see as far as as far as regulations in the next few years, and also a lot of the blend and extend that's been going on lately? Are we going to see the banks kind of have to clamp down and call these loans that they've been extending? So two-part question.
Sure, I'll answer the second one. I'll go in reverse order. So I
Mhm.
think, lend and extend has been part of banking for as long as I've been involved in it, regardless of
Right.
cycle, right? I do think that this cycle is a little bit different, because when you kind of trifurcate the banking system in the U.S., you've got the larger banks, JPMs, Wells Fargo, Bank of America. You've got the regional banks, U.S. Bank, PNC,
Mhm.
Truist, and so on. And then you've got the largest swath of banks in this country, about 95%, that are more or less less than $15 billion, right? That's where most of the banks are in this country, roughly 4,200, 4,300. Okay? So what's happening in each of those sectors is a little bit different. I think the largest banks, primarily because of the increase in the regulatory burden, which they complain about. I used to complain about it when I was a CEO at Wells. That's, every CEO's God-given right, I guess. Fact of the matter is, one of the greatest places to be a bank is to be a large bank in the United States. Hard stop, no matter what anybody says, right? What they're doing, because their capital requirements are going up, right? They'll be a little bit less than the initial Basel III endgame proposal last year, but they'll still have to go up. They're going to look at their customer base and they're going to say, where do we earn the best returns from our customers for the amount of capital that we have to assign to those customers, right? For those relationships. And I think the largest banks have all made the following decision, and that is, in commercial real estate, we're going to allocate capital for the largest, most profitable customers. So they're going to focus on their top 500 or 1,000 or 1,500 or 2,000. And that's going to be it, right? Will they still make some commercial real estate loans to middle market customers and high net worth? Yes, but not at the same level they have. So I think the amount of lending that they're going to be doing because of regulation and because of capital requirements is going to decline. I think the expectations for capital levels and also policy and compliance for regional banks was increased significantly with the demise of Silicon Valley and Signature. So the expectations for those banks and the capital levels is going to increase, not decrease. They're going to go through the same process that the larger banks are going through. And what they're going to conclude, and I've heard it from all their CEOs, I've heard it from their CFOs and heads of real estate, is they're going to reduce the size of their real estate books. They're not going to do it in a way, I think, that creates a catastrophe in commercial real estate. But I think what they're going to do is they're going to say those projects that are really problematic and incredibly over-levered, they're not going to extend. Those that are higher loan to value but still performing, but maybe not of the same quality as when they were originally underwritten because values have come down, they're going to extend those. That's a very rational thing to do. Now, having said that, what we're seeing at Fortress, particularly with the regional banks, but not exclusively, is we're seeing those banks begin to sell some of their loans either in a portfolio or on a one-off basis. So, for example, we bought $1 billion, I'm rounding here, loan portfolio from Capital One, right? And about a year or so ago. And we can talk about that if you'd like, but that's just an example. I think that the banks in this country that are under the most stress, right, are medium-sized and smaller banks, the community banks. Right? And the reason is that the banks in the first two categories are actually making a reasonable amount of money. If you're in the lower category, those banks just are not generating the kind of net interest margin that they had historically, and they're stuck. So because their commercial real estate loan portfolios are a disproportionate size of their loan portfolio, and they're being criticized from a regulatory standpoint. I think for those banks, it's going to be harder now to lend and extend, and I think they're going to reduce the size of their portfolios slowly but surely over time.
And Tim, those are not the candidates I would presume for an asset sale like you did with Cap One, right? Because they can't take the hit to earnings if they were to sell the loans outright at a loss to you. Is that a fair assessment?
Well, their capital, it's a really good observation, Michael. Their capital levels are definitely lower, right, than some of the regional banks and the larger banks. Having said that, I would say that they were generally pretty good lenders. They didn't have as much office concentration, and a disproportionate, in a good way, amount of their portfolio are multifamily loans, which
yes,
relatively well. So what you're seeing is some of those banks selling some of those portfolios where the price discount is really to rate as opposed to credit. So, for example, Luther Burbank, which was just acquired by Washington Federal sold the bulk of their portfolio, rumored to be sold in the low 90s to PIMCO via Bank of America. There was a price discount. Bank of California did the same thing recently with a multifamily portfolio, primarily one that they had originated that we looked at. So those types of price-related sales that are being sold, let's say in the low 90s, high 80s, those are really not much of an interest to us. What we like in our distressed investing part of the Fortress lending platform, we like to focus on both, whether there's both a credit and a price discount.
Thank you.
That's interesting. Just a question for you here, just to tie this back to what this means for our clients. Our clients are, owners of commercial real estate. Many of them are institutional, some are family offices. How would you tie this back to their situation? Obviously, Fortress, you guys are a private, non-regulated, you're not a bank, right? Private equity company with many tentacles and different funds and verticals and strategies. But what does this mean in terms of the macro environment, I guess, as it relates to real estate lending and borrowing?
Yeah, as far as like general access to capital, is it a different door? Give us kind of your thoughts.
Well, I think what will likely occur, and this is one of the reasons why we're raising the private non-traded REIT, real estate lending is something similar to what happened on the corporate and commercial side in terms of private credit, which has been going on for the last 2 decades. You step back and think about it. In the US, we created $1.5 trillion of private credit outside of commercial real estate in corporate and commercial middle market companies, right? So think about that. That's the equivalent of the loan books of 2 of the largest banks in this country.
That's right.
That's what's happened. I think that's going to happen in commercial real estate too, where you'll see private credit begin to take a higher market share, right, as regulated institutions begin to slowly but surely reduce the amount of lending that they want. It doesn't mean they're not going to lend. There's banks out there that are lending and being very aggressive today, but I think the market shares are going to shift. So for your clients, I think it's a very good idea, and for you advising your clients, to make sure that your clients are accessing those private, non-traditional lenders who are going to, just like we're doing, all of our competitors are doing the same thing. They're seeing the same opportunities, and they're raising capital to be able to provide credit at maybe a little bit more expensive than a bank might have provided, but not necessarily on a distressed basis. So let's say a few years ago, if they could have gotten, your clients could have gotten a loan at, say, SOFR plus 200 or 250 over, now it's going to be 350 to 450 over. Is that more? It is. I would just respectfully encourage them to just get over that, because the period that we were in a few years ago is not normal. That's abnormal when you look at the history of absolute rates and spreads and so on. Get over it, right? But make sure that you've got more relationships from a lending standpoint. And that's where I think your advice and relationships can help your clients, because it's going to be a little bit more complicated to borrow money than it was historically.
Yeah, I mean, you're talking our book. I mean, that's our business strategy, right? Is to kind of become the relationship nexus for these firms, as sort of that relationship banking business is kind of being undermined by just the macro trends that we're seeing towards private credit.
Yeah, and some call it shadow banking.
Shadow banking, yeah.
And you talked, very trenchantly there about get over it, because I mean, the era when everyone just stuffed their money in a bank for 0 to 3, to 0.5%, and they lent it out at SOFR or LIBOR 210 or 220, that era is over.
It just is. I mean, it was
Yeah.
great. It lasted for lots of people.
Yeah.
But it's just over. And I don't mean to be flippant, but I think sometimes some of the best advice that you can provide to your clients, that we provide, to our clients, is just look, that I know that's the way it was. It's just
Mhm.
not that way anymore. You need to look at what the facts that we have in front of us and deal with the facts that we have today.
Mhm.
Yep.
Okay.
Mike, you want to hit him with another one, buddy?
Tim, do you miss being a big bank CEO with all the things going on with Basel Endgame and the environment that we're talking about with some of the banks? Is that something that causes you some thoughts on how you'd want to get back involved in something like that?
No, I miss the people at Wells Fargo that I was privileged to work with for decades. And I miss the customers. I miss our investors. Those were some of the greatest years of my entire life. It was a privilege to be the CEO of Wells Fargo, and not necessarily the time frame, because we were dealing with a lot of issues, but I was glad that I could help the company move forward. But I love what I'm doing right now. I'm deep down, I'm a deal guy. I love this business. One of the fun things for me at Fortress is that while I really enjoy being in and involved in and around commercial and residential real estate, that's a part of what we do. We have a broad set of funds. So the deals that come across our investment committee every week are just fascinating. So it's just a lot of fun.
Interesting. So why don't we pivot a little bit here? We're into an interesting time. I don't want to rehash the events of this last weekend, but we're in a tumultuous time for the country as we go through an election with a very divided country and opinions of different things. So, what advice would you give to a potential new Treasury Secretary who's going to, we don't know if we'll have a new one or not, I guess, but, what advice would you give that person?
Well, I would tell him or her that that your primary focus should be to get our budget under control and to look at our current debt levels in this country and develop a long-term plan. I mean, it took us decades to get into the mess we're in right now, and it is a mess, right? The interest burden on our debt, right, for the first time is now greater than our defense budget.
Mhm.
Not a good situation given the geopolitical challenges that exist in the world today and some of the, bad actors that are out there. And so
Mhm.
my recommendation would be to just acknowledge where we are and just say, look, let's develop a 20-year plan, a 50-year plan to pay off the deficit, or to bring the deficit back into check, meaning balance it, and then or the budget back into balance, and then to start. But it's got to be a long-term solution. Politicians, because they're elected for short um, terms, whether it's 2 years or 4 years for president or 6 years for senators, have a very short-term time frame, and that's not how we're going to solve this problem. If we start to try to figure out how to resolve these issues of the annual deficit and the overall debt in a short period of time, all that's going to happen is everybody's going to yell at each other, and they're not going to get anything done, and it's only going to get worse.
Mm-hmm. Yeah, I mean, I forget all the stats. The rate of change of, obviously, the national debt has accelerated tremendously. Just the sheer amount is staggering. And I think that if you were to sum it up, we're not going to spend our way out of it with some sort of new borrowing plan to create, economic stimulus. I think what you're saying is you have to reduce spending and figure out a longer term path.
I mean, if we could bring the decision making, I'll give you a great example. I'm involved in a group called No Labels, and we have worked with the U.S. military, retired U.S. military leaders, and they will say the following, and that is, if we just streamline, right, the way in which we make our budget decisions in this country and agree that we'll have a budget as of a certain date every year, right? Which is, by the way, by law, what we're supposed to be doing anyway, right? The leaders in the military would say they would sign up for a 10 to 20% reduction in defense spending, because if we can get more efficient, we can save money, right? Those are the types of things that we need to do in terms of addressing this really important issue, because I actually think our debt, right, is one of the biggest security issues that we have in this country.
It exposes us to needing foreign funds to keep our own balance going, so.
Among other things, that's exactly right.
So why don't we, we're kind of getting short on time here. So why don't we pull it back to some more, real commercial real estate related topics, since we've kind of ventured into the stuff that I'm certainly not qualified to think about. So let's talk about that. So what are you most excited about as we kind of move here into, I guess it's now July, and kind of head into the end of the year, and seems like some rate cuts might be coming down the pike. Who really knows? What are you excited about? What are you looking for? And give us a little bit of insight on that.
Sure. So within commercial real estate debt, we're very active in terms of buying loans, as I mentioned earlier, at a discount. Sometimes they're performing, sometimes they're not. I think that is a multi-year opportunity, primarily because this cycle is driven by rates as opposed to economic calamity and overbuilding. Again, office is a little bit different. So we're very active there. We've purchased about $1.5 billion within the last year. My guess is we'll probably purchase another $1.5 billion in the next year. We're also focused on buying some of the tranches and some of the larger SASB, single asset, single borrower transactions. The way that we go about prosecuting that business and looking for opportunities is not to wait by the phone and hope somebody calls for a bid. What we do is we look at all the SASBs that have been originated, then look at the underlying properties, find those properties that we think are the highest quality properties in their market, and then focus on buying securities in those properties so that we are able and underwrite those properties so we can make a relatively quick decision. We're also very active in terms of providing what I would describe as kind of rescue capital in situations where you've got a very good borrower, developer, owner, but their loan has come due. They can get a new senior loan. It's going to be a little bit more expensive than what they're replacing, but they need that middle capital. So whether it's mezzanine or private equity, we're providing that. And then, as I mentioned, we are very excited about being able to just make senior high quality commercial real estate loans. We just think that's a great business. So, my guess is that we'll probably originate in all those sectors, $1 billion to $2 billion a year, and that'll be absolutely fine. It'll keep everybody busy.
So on the rescue capital topic, clearly, this is a hot topic for a lot of folks for, not the best reasons possible, right? I mean, we're seeing a lot of folks who are struggling.
Well, people are looking to see where the distress is and when it's coming.
Right. Yeah. But, there's this bid-ask spread and this kind of situation right now. Part of getting these transactions to work is what we were talking about at the beginning, which is that this area of extend and pretend, blend and extend, whatever you want to call it, has to kick the can. It has to slow down. And then also, I think, to your point,
need to be repriced.
But that goes back to what Tim was saying earlier, which is that there's, it's not this. At least you don't feel like, if I were to put words into your mouth, we're in a place and time where if you're an owner of real estate, you're just going to hold your breath and hope, that
everything goes back.
That rates are coming back to where they were, right? So with that, are you guys seeing more are you guys seeing the ability to deploy preferred equity and mezzanine debt directly in transactions, or are you having to fully recap with new debt most of those transactions that you guys are looking at? And I ask this kind of specifically because I think what we've seen is it's been very difficult to come into an existing capital stack we found in this market with preferred equity or mezzanine, just because you know, it would be a signal, I think, to the senior lender that the loan that they're in is not so great, and they might not want that on their books, and they'd like to rather be potentially just refinance and hold. But I'd just love to hear what you guys are seeing your platform.
Well, if you are an owner of commercial real estate and you can convince your senior lender to extend their existing loan at a higher price, but without a significant pay down, you definitely want to take advantage of that, blend or pretend and extend portion of the cycle. I think that's a prudent decision to make. But if you can't do that, then unfortunately, what you're going to have to do is you're going to have to bring new capital. If you can bring that entire that new capital in and convince a new lender, that's great. But if you need some help, that's where preferred equity or mezzanine can come in. But it comes at a price. I mean, our mezzanine preferred equity is priced at 15%.
Right.
And
So let me ask this question a little bit more specifically. So if you're at 15% and you're accruing and probably being paid current a portion of that 15%, right? You're probably taking 7 of it PIK and 7 of it current or something like this, just based on the cash flow of the underlying asset. So but you're looking out towards a refinance, and you're looking at the 10-year treasury, and where if it's a multifamily asset, it's Fannie and Freddie, or what their spreads are, and so on and so forth. And you're probably looking at getting taken out, right, with a refinance and underwriting to that. I think that's the challenge that we've seen, is that,
exactly, where the mezz and pref is a little more than where a senior would be. And what should everyone do? You can't underwrite to a sale, or we think.
I think that this is going to be a really good time for folks like you here over the next 6 to 12 months, if I were to sum up what I'm trying to get at here, because I just think that people are working on sort of this hopium that those rates are going to come down, those long-term rates, and if they are, then yes, they can kind of plug their way along. But I think there's going to be a lot of transactions that will need to be kind of fully recapped, because a preferred equity, a sophisticated preferred equity investor is going to see that and feel like, well, if I do this, the only way I'm getting out of this is if they sell it. And if you're okay with that, because that's the profile of your fund and the returns you're trying to hit, then that's great. But many of the funds in the market are looking to underwrite to a recap,
or they're constrained in the back room by that, by their fund.
I think that's a fair observation. I guess what we find is that preferred equity and mezzanine tend to make more sense when there's multiple opportunities for exit. So not just a sale, but there's some sort of other event, meaning maybe the reason that it's going to work better is because you've got a property that's underperforming, and you've got a new strategy and new investment that's going to be made in the property, or you lost a tenant, right? Or you want to reconfigure the property so that the returns from here forward are a little bit higher than they've been, say, in the last few years. So it can be event driven and property driven for sure. But I do think that you're correct. I mean, what we generally look for in our preferred equity and mezzanine is multiple potential for exit. I mean, our goal is not to make that investment and then hope to own the property. I mean, if that happens, it happens, but that's not our goal.
Right. Well, no, this has been great. Just trying to wrap it up here in the interest of time and let you get back to your more important work. And really appreciate you joining us today. And thank you for doing that.
Thank you very much.
Happy to help. And look, we love working with you guys and your partners. And you know, it's a pleasure. But again, to reinforce for all your clients, I think, you know, this is a time in the cycle where it's really, really important to make sure that you're examining all your options and you've got some good advisors.